Hi everyone, so we're back doing what we do best, which is exam questions in accounting. Woof woo. So we're going to look at how to do a particular type of intercompany adjustment for the consolidated statement of profit and loss. But first I wanted to show you a trick that I learned from doing an exam question just yesterday. So even, you pick up so much information from doing the exam questions, you work out more efficient ways of doing things. So I recommend that you do as many exam questions as possible within the given time limits. Now, what I wanted to point out is that we know for the proportionate method, you might already know this trick, but hold on, you might not. So under the proportionate method, you probably know in working free that net assets at acquisition of a sub let's start off actually with the group structure. So imagine you have A to B is 80%, 80% ownership, A to B, and that's the group. So 20% is coming from NCI. Okay, so we start off with that. Now, in working free, using the proportionate method, you'll know that net assets at acquisition, NCI acquisition, is equal to 20% of net assets at acquisition of B. Okay, now it actually follows that NCI at year end for B is also equal to 20% of net assets at year end for B as well. So this is a trick I didn't know before, but this is worth knowing because it might save you a lot of time. Was there something else I wanted to point out? Yes, there was. Yes, there was. Now, an adjustment you'll need to make for is intercompany. You'll need to make is for intercompany dividends, intergroup dividends. I should probably put intra, so within the group. So I'm just going to rub that out, and I'm going to put intragroup, like so. Okay, intragroup dividends. Now consider this example. So in A column here, just rubbing that out, you have investment income of 300k. So A makes a lot of investment income. Now some of that income includes dividends from subsidiaries, so we need to make an adjustment for that. So for example, if I told you that B issued total dividends of 100k, what do we do, Basil? Well, we have to know where those 100k of dividends are going to first. So we know that 80%, A has 80% ownership of B and NCI has 20% ownership of B. So 80% and 20%, 80% is going to go to A and 20% is going to go to NCI, because the amount of total dividend income is total dividend income an entity is receiving is based on how many shares it has. Okay, so then that means A is going to receive 80k and NCI is going to receive 20k. So how much do we reduce the investment income by? Well, it's going to be the 80k. Okay, so minus 80k. Please don't do minus 100k, which some people might do. Think about where the 80k is being paid to. And I want to point out as well, non-controlling investors are not part of the group. So as you can see here, A and B are within the circle of trust, and NCI is sitting outside. like Ben Stiller in Meet the Fockers. Okay. Now, another point I want to make about this is that the adjustment doesn't impact consolidated retained earnings. Right, we're going to explain why. So let's do before adjustment and after adjustment and adjustment to understand the double entries we're posting, because these double entries are going to show you why you don't need to adjust retained earnings in your workings. So before the adjustment, the 80k in A and B, in A we recognized we received cash of 80k. I'm just assuming it was paid free cash, and we credited income of 80k. Now I want to make a point that income is part of retained earnings. Okay, so your profit and loss statement is just basically included within your total retained earnings figure. That's one way of seeing it. Now for B, what's actually happening? Well, B is paying out cash of 80k, but it's debiting its retained earnings to pay the dividend of 80k. So your cash group, there's no impact because one entity is receiving cash and the other one is reducing its cash. Total cash, there's no impact. Total retained earnings, no impact. Okay. So the overall entries, what's actually happening, the net effect, is cash is staying the same, but what we're actually doing is we're debiting retained income. We're debiting retained incomes of 80k, and we're crediting income. So what we're actually doing is we're debiting retained earnings, 80k, crediting income, 80k. And income is eventually going to feed into our retained earnings through the profit and loss figure. So there's no impact. So the adjustment we're actually posting is the opposite. What we're actually doing is debiting income, 80k, and crediting retained earnings, 80k. So as I said, income is feeding into your retained earnings figure eventually, so there's no impact on your consolidated retained earnings figure. So just watch that. Okay, then that's all I wanted to say. As always, please put any feedback in the comment section and let me know if you've enjoyed watching the video. Thanks. Bye.